Thank you all very much for joining us this morning. My name is Steve McMenamin, and I'm your host for today's event, which is part of the ongoing series of the Greenwich Roundtable. Our topic this morning, After the Fall, Picking Up the Pieces, is a continuation of a session we first held in October of 2000 after the tech bubble burst. It was our suspicion at that time that the knives had stopped falling, but in hindsight, we were wrong. Hopefully today our panelists, all practitioners, can tell us whether fishing or not. Today we've got two rising stars and one newly minted legend. I'll briefly introduce them. Jody LaNasa is the managing partner of Serengeti Asset Management, a hedge fund focused on special situations. Before founding Serengeti, Jody headed Goldman Sachs' proprietary investments inside that firm's special situations group. Before Goldman, he worked at Wachtell, Lipton, Rosen, and Katz in the bankruptcy and M&A departments. Jody served on the board of directors of Genesis Health Ventures and NeighborCare. Jody also served on a number of unofficial bank debt and creditor committees, and he earned the magna cum laude distinction from the Harvard Law School. Sitting to Jody's left, Christopher Byrne is a portfolio manager with Goshen Investments, a hedge fund focused on equity long-short strategies. Chris founded Goshen with seed capital from Tiger Management in 2006. For Goshen, Chris was a member of the Eastern Asset Investment Team, as well as a managing director of the Fortress Drawbridge Global Macro Fund. Before Drawbridge, Chris was a portfolio manager with MFS Investment Management, opening their Singapore office. Chris began his research training as an analyst with the State Department's Bureau of Intelligence, earning that agency's top award for his analysis of developments in the Asia and Middle Eastern regions. Sitting to Chris's left, John Paulson is an old friend of the Roundtable and the president of Paulson and Company, which he founded in 1994 and focuses on merger, event, and distress strategies. Before that, he was a GP at Gruson Partners and a managing director of M&A at Bear Stearns. And managing director at Bear Stearns. Jeff Tarrant gave John a much better introduction at Protégé's annual meeting last summer with his back-of-the-envelope calculation of their subprime short strategy. In that calculation, Jeff revealed that Paulson and Company had set a record for the most profitable series of trades in the history of the industry. With $32 billion in AUM, Paulson's earned most of it by growing the portfolio. And Liz Hilton is back in the saddle today as moderator of the Roundtable. She's a partner in charge of manager selection at Barlow Partners. Before that, she worked with Gilbert de Botton at GAM, as well as the Dartmouth Endowment and the Common Fund. She's lived through a few market cycles and brings some perspective to today's discussion. So please welcome Liz as she sets the table for us today. Liz?
Great. Thanks, Steve. Nice to be here this morning. A lot of people have made the comment to me that we live in interesting times, and I think that we live in right now in a pretty extraordinary time. And I'm not going to. I was thinking about what to say this morning, and went through and picked out a bunch of statistics about what happened last year, and I'm not going to belabor it because I think most of us in this room are very aware of the precariousness of what's going on in the marketplace. I mean, I don't think there's any place to hide with market declines, the volatility, the dollar, the inflation. Clearly, the credit situation is in my view dire, is not completely over. I think there are plenty of shoes to drop. We've got three panelists here this morning that I think have a lot to say, and so I'm not going to take any more time. I'm just going to let them go into it, and we'll ask some questions, and hopefully the audience here will have some questions as well. And to start off this morning's comments, we'll go with Jody on my left here.
Yeah, thank you very much. Well, it's been quite a week. It's not often that you see one major broker-dealer sell for $2 and we have $8 of book value. Another one come very close to following them. And the Fed make 5 announcements in the span of 7 days. Unfortunately, I don't think this volatility is going to be diminished anytime soon. I think it's interesting because many people think the Fed gave us a gift on Monday and Tuesday. But the gift was a chance to sell more longs and reestablish shorts. The reality is not much has changed from where we were a week and a half ago. What's the fundamental problems we face are the same problems we faced a week ago. We had this big pothole called Bear Stearns that we didn't anticipate, that came and the Fed filled it, but the Grand Canyon is still sitting right in front of us. We're in the midst of the worst credit crisis this country has ever seen. Over the past 5 years, consumer and credit debt grew from 10 trillion to 17 trillion. And unfortunately, that credit growth needs to contract. And that contraction process is a very painful process. How did it grow so fast? It grew so fast, as everyone here knows incredibly well, because it was very free, it was very cheap, and there were no limits on how much leverage you could have. You could lever bank debts 10 times and pay 35 basis points. You could lever AAA assets 99 times and pay 15 basis points. Unfortunately, those times have passed, and the contraction needs to happen. We're moving from an environment of levered fixed income returns to an environment where even in fixed income, returns are assets being repriced to be attractive on an unlevered basis. So what does this mean? It means a couple of things. One, the banks are in trouble. Why are the banks in trouble? Because they came into this event over-levered. Historically, over the past 10 years, banks average leverage of 17 times tangible assets to tangible equity. When this crisis began, in September, at the end of last year, they were levered 22 times. So what does that mean? That means a couple of things. How did they get stuck being leveraged 22 times when historically you run it 17 times, and we just described how credit spreads were at all-time tights? Well, part of it was they didn't anticipate the markets as shutting down last summer. They got stuck with huge portfolios of hung bridge loans that were being used to finance their private equity LBOs. They got hung with large portfolios of mortgages they were warehousing, hoping to securitize, not anticipating the securitization markets would shut down. On top of that, they had all this off-balance sheet leverage. They were trying to do anything they could to grow earnings and report 15 to 20% return on equities, or in the broker-dealers cases, 25 to 35% return on equities. And in doing so, they use all these things like SIVs and ABCP and all these off-balance sheet vehicles. And now those vehicles are getting unwound, and those assets are returning back to the bank's balance sheets. And the third thing was they didn't anticipate that defaults would ever increase. We were operating for 5 years in a low default environment, and they thought that would continue. So they felt comfortable putting on additional assets, using additional leverage to try and generate better returns. And now all those assets they borrowed are suffering losses. And this is my point on why things aren't different. It's not like we went through a lot of losses over the past week and a half. We went through a liquidity crisis, and the Fed saved the liquidity crisis, and that's good. But the losses are still to come. How big are those losses going to be? I don't know. I don't think anyone knows. Some people have estimates, but they're going to be a lot. And not going to be much more than the $125 billion of losses acknowledged so far by U.S. banks. And the leverage, we talk about the leverage, 22 times tangible equity, tangible book. For the broker deals, it's closer to 30. For the commercial banks, closer to 19. But that's ignoring the CDS market. There's $54 trillion of CDS. For some of the commercial banks like JP Morgan and Citigroup, their CDS exposure is 3 to 4 times their exposure on the asset side. Yet no one talks about it. And that too is a huge form of hidden leverage that needs to be unwound. So the problem with levered institutions is that when you start facing losses, you can't absorb them. Institutions that are levered this high, when they start facing losses, they have to contract their credit, and it's like years of earnings. So let's just use a number of like 750 as the amount of losses that we incur by the banking system. Over the past 5 years, the bank's been averaging about $200 billion of pre-tax income. So that's 4 years, almost 4 years of earnings to go to replenish the losses from what's on their balance sheet. But the problem is that $200 billion of earnings for the banks is still too high. Why? Because the environment's changed. There's no more syndication. There's no more syndication income. People aren't committed bridge loans and syndicating them. There's no more securitization income. There's no capital to deploy to earn these excess spreads because they're over-levered 22 times to begin with. Where is the capital going to come from to deploy to take advantage of these excess spreads? And their cost of funding is higher. The Fed's cutting interest rates. That's great. The Fed's cutting interest rates. But there's lots of competition for deposits. So there's a floor on how low deposit rates can go. On top of that, the credit markets are pricing bank credit spreads at all-time highs. So for where they can't fund through deposits, if they do it in the marketplace, it's expensive, so they're forced to go to the Fed. The Fed's becoming the repo market for the entire financial system. Now, the other issue is that the corporate bank loan market is very sick. If you need money, you can't get it today. And for an economy like the United States that's been so dependent upon cheap credit, easy credit, when the corporate bank loan market stops, that means it's hard for companies to grow. And that's going to have repercussions for the economy. It's going to lead to rising unemployment. And when housing prices continue to decline, it's going to lead to decreased consumer spending. I think we're still in the beginning stages of the problem. And while we faced some abyss and got around it, there's still a lot more pain to go. Now, let's just talk about what's happened over the past couple of days, and has it actually made the situation better or made the situation worse? In some ways, it's made the situation worse, because while the Fed's trying to limit the pain, in doing so, they're making the pain, I think they may be making the pain greater in the future. Why do I say that? 2 points. I want to talk about the GSEs and talk about the brokers. Talk about the brokers first. So the Fed gave the brokers access to discount window. So you and increased the number of assets they take at a discount window. So you as a broker-dealer can now go to the Fed and repo your most illiquid assets at very high exchange rates. And stay solvent until the losses come. Now, the issue is that's the same treatment that the banks have, but the banks are highly regulated. They have examiners who come in multiple times a year and examine the books. They have a limit on how much leverage they can use, and if they go below 5%, if their Tier 1 capital goes below 5%, they're forced to recapitalize, and if it goes below 4%, they're forced to sell. The brokers operate at 30 times leverage versus, and there's no limits on what they can invest in. There's no one examining their books. It's a disaster waiting to happen. On the GSEs, I understand that we want the mortgage market to stabilize and spreads to tighten, but they're levered 150 times if you include the value of their guarantees. People keep forgetting derivative exposure and looking at leverage ratios. They're levered 150 times, and they own a bunch of mortgages. And Fannie's already experiencing 100 basis points delinquencies. Freddie's experiencing 60 basis points, 70 basis points delinquencies. They're not designed to tolerate losses on their mortgage portfolios. And to tell them we're going to decrease the capital surcharge so you can go out and buy more mortgages, while it helps the mortgage market today, it's creating more problems in the future. Now, a lot of people say, you don't fight the Fed. You buy bank stocks when the Fed's cutting rates and providing all this liquidity. And I understand why they say that, but I don't think it's you don't fight the Fed. I think it's you look at buying bank stocks and going long financial stocks when delinquencies are plateauing, NPAs are plateauing, and the government and the banks either recapitalize or having the government absorb their losses. We're not there yet. Maybe we'll get there in the near future, but we're not there yet. But those are the signs I would look for in terms of when's a good time to go from being short banks to being long banks. So, a couple additional points. I just want to go back to what I talked about in the beginning about what happened with Bear Stearns. So, you had an institution with $80 of book value that sold over the weekend for $2 per share. So, what happened to that $80 of book value? Not only did it sell for $2 per share, but they gave back to the Fed $30 billion of toxic assets, like $250 per share of toxic assets. Now, what that means is the next time a financial institution gets in trouble, they won't just be able to go to the Middle East or go to Asia and raise capital, because the cost to rescue capital just got substantially higher. So the money that Citigroup and Merrill Lynch and Morgan Stanley raised earlier this year isn't available for the next person who gets in trouble. And I think that's something you have to focus on as we go through this through this time. And there are going to be days like Wednesday when vicious rallies occur, or Tuesday, sorry. But the most vicious rallies oftentimes occur in bear markets, and you need to use them as a gift to reduce your longs and reestablish your shorts. And in this kind of market, trading is incredibly important. So, not surprising given everything I spoke about, my investable themes. When I think of investable themes, my favorite investable theme is staying short the leveraged financial institutions. I mean, there's one bank in this country which is viewed as like untouchable. It trades at 3 times tangible book. A third of its tangible book is mortgage servicing rights. Mortgage servicing rights at best are worth 1 times book. If you back out those, it's trading at 4 times tangible book. It's got a great deposit franchise, got a great brand name, doesn't talk to investors, doesn't hold conference calls, doesn't hold analyst days, but it has a lot of assets. It has a lot of home equity loans, and It has a lot of it has a lot of mortgage loans. It has a lot of commercial construction loans. And a lot of those loans are in California, and a decent chunk of those construction loans are in Florida. I don't care how good of an underwriter you are, with a large pool of California and Florida loans, I don't see how you avoid losses. And when you start having losses, that halo goes away. And your stock price declines because of the losses, and your stock price declines because you lose that premium because you're untouchable once you become touchable. Anyway, those are my thoughts for the day.
Well, well, it sounds like you're still picking up the pieces. I don't think we're, given your comments, you've mentioned the banking system, the financial institutions. Do you have any thoughts on the impact on opportunities in the consumer area?
I think when you're seeing housing price declines like we're seeing, and when you're seeing unemployment rising, so housing price declines, you're seeing trillions of dollars of wealth being destroyed, and you're seeing unemployment rising, and you're seeing headlines of just constant layoffs. It's really hard for the consumer spending to stay strong. And I think ultimately that consumer spending also gets hit. The difference between retailers and banks, I believe, is banks are much more levered than retailers are. So retailers over a 6 to 12 month period of time can readjust their inventory to account for a lower level of sales. And as long as they see the slowdown coming, they can adjust for it and get through it and generate attractive free cash flow yields. Banks, when they're levered 20 to 30 times, they can't adjust their inventory levels. They can only sell down assets and then uptake losses. It takes them much longer to fix themselves than it does to fix a retailer. So I'm not positive on retailers, but I'm not as negative on retailers as I am on the banks.
Great, thank you, Jody. Chris?
Thank you. I wish that I could deliver a more upbeat message, but I'll be somewhat along the same lines, but a couple distinctions I'll make. First of all, I'd like to sort of break one of the interesting things about this crisis, as we all know, securitization. And I think this has made it slightly different than some of the other banking crises I've seen, particularly out in Asia, in the sense that securitization is both bewildering, but it actually accelerates the recognition of the losses. I mean, that's, I think, actually one of the pieces of good news, because you now actually have a discounting mechanism in the credit markets that you didn't have before. If you think about the typical game the banks still aren't showing the losses on the loans. They're walking around saying, oh, no, that's fine. Our delinquencies are up a little bit, but, it's fine. So that gets bled out very slowly in the typical on-balance sheet institution, whereas the credit securities are now discounting it very, very quickly. So I think we've got something terrified, but we're also front-loading a lot of the losses. At the same time, that's triggering a liquidity crisis. And this is all what I consider to be sort of the fast twitch phase of this downturn. If you think about the U.S. broker-dealers, they went around telling us that with the magic of securitization, they were offloading the risk to these mysterious people, naturally overseas, who were taking all the risk, and they were clever and understood everything and were constantly passing on the risks. But when the music stopped, if you look at the end of last year, the big five broker-dealers had about $4.3 trillion of assets, supported by $147 billion in equity. I mean, that $4.3 trillion is 30% of GDP. At some stage, you're not passing off the risk. You're just simply, these traders have just been loading it onto the balance sheet. So the first phase of this is the slow twitch, is the quick twitch, where we're getting the liquidity crisis and the marking to market of the credit securities. The second phase is going to be the slow twitch crisis, which is the actual appearance and work through of the delinquencies. And that's going to be, I think, the more grinding process. If you think about the way this is all unwound, one thing I've noticed about the Fed, I think, if you'll go back and forth, I think they have moved extremely slowly. And I'm going to give you some very particular examples of why I think that the Fed and other officials, wittingly or unwittingly, have worked to try to keep calm. And in so doing, they've delayed resolution. Last year, I picked this. It's an out-of-the-way example, but it shows somewhere they could have moved early and didn't. Last year, there was one time, maybe one of the biggest, in fact, the market cap was bigger than Countrywide, there's Doral in Puerto Rico. Some may have heard of this. This was a giant mortgage Ponzi scheme. went the full route. And last year, to prevent the bank holding company from defaulting, they allowed the holding company to do a transaction selling MSRs. Now, you've heard mortgage servicing rights, which Jody mentioned. This is an intangible asset. If somebody has a mortgage, they present value a stream of cash flows that they'll get from servicing this mortgage, and there are two scenarios under which it goes away. One is that you prepay, poof, no more mortgage, no more asset. The other is you go delinquent. Then let's call it a mortgage servicing liability, because you got to pay someone a call and, hound these people down. And I don't know, it's very hard to find some of these people in Puerto Rico, and it is. I mean, it's actually a very hard market to collect in. Last year, the Fed allowed the holding company to sell intangible assets to the bank. So the bank sent cash up to the holding company so that the holding company could make a bond payment. Now, that flies in the face of a 100-year-old doctrine called source of strength doctrine, that shareholders of the bank should be, if anything, giving cash into the regulated entity instead of the bank. The fear was always that once you created holding companies, the bank would subsidize the holding company. And the Fed allowed exactly that to happen, because all is well. Don't let anybody see a failure. Don't let them see a problem. I mean, it's not like we need mortgage lenders in this country. There's plenty of capacity. If this were a cement company, we would have just shut it down. Some Puerto Rican cement company went bust. On we go. But the Fed, trying to make things look good, has tolerated a lot of monkey business. The second thing they've done is let reserves fall to appalling levels. I talked about, I've got a handout later with some FDIC data. They've actually let reserves as a percent of impaired loans fall consistently. You can't say that this is an active regulator. This is somebody who not only kept rates too low for too long, but on the supervisory side, let the banks overstate their earnings systematically. So as we move into the slow twitch of the crisis, the slow twitch phase, the banks, the on-balance sheet institutions, as distinct from the capital market entities that are so levered and having liquidity and securities losses, the banks, as we move into the slow twitch phase, the banks are very ill prepared. And so we're looking at this particularly in the regional banks. Now, just to give you a sense of the magnitude of some of these issues, the famous 2006 subprime vintage was $600 billion. The construction loans on bank balance sheets today are $630 billion. And those construction loans, which have been the fastest growing area in the banking system, one of them, potentially have very high loss content. The FDIC doesn't break it out, but at least we think possibly $200 billion of that is land loans. To give you an idea of the collapse in the land loans, down in Florida, you're getting 15 cents on the dollar for this stuff. And the banks lent 75 on the dollar. So the loss content in the construction area can be very high, and with the total freeze up of the mortgage area, you will have a high. Construction loans alone have the potential to double non-performing loans in the banking system year over year. That's just construction loans. And again, this isn't a slow burn. When this all started, we said first it's subprime, then it's a little more than that, and then it's just the investment banks, but there will be a slow twitch crisis in the banks. The other thing I would just say, the other asset class I would point to, and I think a lot of you will have observed this as allocators, is commercial real estate. We know that there were transactions that made no sense in commercial real estate. Did any of you see, what was it, the Sam Zell, it's raining liquidity or something? Who was on the other side of those trades? Commercial banks. If you actually think about what happened, and this is going to be concentrated in the banks between $1 billion and $10 billion, which is going to be very devastating for a lot of communities. Think about the mortgage business. It went national. Angelo Mozillo went from 5% market share to 15% market share. People didn't get their mortgages down at the local bank. People didn't get their credit cards there. All the consumer, which was where you got yield, went national. And the local banks, of course, they're looking around. They're like, well, where are we going to make loans? Oh, we know this local builder. And in fact, we can get a personal guarantee from him. That's one of the great assets these banks point to, is the personal guarantees that they get from people. I had the CEO of a bank call me the other day, and he said, he was asking what he should do with a building. You can guess what I told him. And he said, we're finding these personal guarantees are really not worth a whole lot. And I said, early on I talked to a guy who'd been at Citigroup when Citi had the trouble in the early 90s. And among the more amusing things he said is, first of all, he said, every real estate project is pre-sold. Oh, every building is pre-sold. He said, because every builder's got somebody who will put down a few bucks and then their cousin, their nephew, and so on. Every building project is pre-sold, number one. And he said, let's see how the money appears when people have to actually go move into the house, if it's underwater. And the second thing he said is personal guarantees. This is just, it's a farce. You can never, by the time you need it, the guy's in trouble. So I think that we're going to have, and in fact, the CEO of the bank said to me, I've got a problem with my board. I can't make new loans. They want us to grow. He said, I am so busy processing non-performing loans. And that will bring me to two other points. One is there's going to be I talked about those mortgage servicing rights earlier. Mortgage servicing rights will turn into mortgage servicing liabilities because there are elaborate assumptions, as we know, passed upon by the accountants, that indicate the probability of default and the value of these things. Well, you've got to spend a lot of money. J.P. Morgan, for example, has had a huge uptick in single-family delinquencies. I'm actually not going to say the number because I have to double-check it, and I don't want to. But it's a large uptick. And a friend of mine went into the bank the other day and said, how are you going to handle this based on the call data? This is FDIC data, not GAAP, early-stage delinquencies. And the senior person in consumer banking got very snippy. He said, we don't run the bank off the call data. To which he said, well, the Fed sort of uses that to track how you're doing, so we assume you put serious numbers in there. There's going to be a lot of expense just in processing these bad loans. And the CEO of the bank said, I don't have time to deal with new loans. I'm dealing with delinquencies, which means that you get a major credit contraction, let alone the capital issues. I'm just talking about management time. So construction loans, commercial real estates will emerge as issues. By the way, I talked to a consultant in California about 2 years ago about commercial real estate loans. I had been stalking one bank in California, and I'd had Julian Robertson shorting it. And Julian actually looked at me at one stage, and he said, you're the only one who thinks this is a bad bank. Anyway, finally, after 3 years, the CFO just resigned, and the auditors left as well. So I think maybe some other people think there's a problem. But a lot of the commercial real estate in California, this consultant said to me, last cycle we had a problem with .coms. They went up, they disappeared. But he said, we think we've got a more stable industry that's taking up a lot of the space in California. That's the mortgage industry. It's not going to be as volatile as the .coms. And it certainly seemed that way 2 years ago. And to be fair, the people in the mortgage industry knew how cyclical this was, and they probably didn't overcommit for office space relative to a normal set of expectations. But this has exceeded even their expectations. And again, you think about Countrywide, AmeriQuest, a lot of these players in California. That's going to be a big hit on commercial real estate. You look at New York City. I kept asking around, what drives commercial real estate? Wall Street. Well, what's been driving Wall Street? Mortgages. So I think we've got, again, commercial real estate will be another slow twitch problem for the banking system. Let me just move on for a moment to China, where I've been looking at those banks for a long time. And I remember, back when, just to give you an idea of the psychology, there's a bank called Bank of China Hong Kong. Now it's a Hong Kong regulated bank. Hong Kong is a very well regulated system. The accounting, the non-performance, everything. It's Hong Kong and Singapore are the best regulated banking systems in Asia. Bank of China Hong Kong, just because it even had part of a Chinese bank in it, could barely list several years ago. Now, and I've got it in this handout, after a sell-off, the big five Chinese banks are valued at $600 billion. They actually have a bigger market cap than the big five U.S. banks. Now, we can quibble about the U.S. banks, but let's remember the Chinese economy is 1/5 or less of ours. And these Chinese banks, cumulatively, have been loss-making institutions. In fact, it's really pretty staggering. These are still very political institutions. And if you actually think over time, just about the simple economics of these banks, which trade anywhere from 2 to now 5 times stated book. If I said to you, I want to give you a bond collateralized by all the loans in the Chinese banking system, and after your financing costs, you get a 3.5% spread. You say, what's the historical delinquency experience? I say, well, 20 to 40%. But U.S. strategic investors have taken stakes in these banks, and also a lot of consultants with PowerPoints have been in, and things are going to change. And that's the Chinese banks, and we're capitalizing at multiples of book value. So I actually think that China is going to be one of the other slow twitch problems of 2008, 2009. They've got a slowdown in exports, which we know is almost inevitable. They have a domestic property overhang. I just had dinner with the head of the biggest private property company in Shanghai. They pulled, in China, they just pulled the IPO. He's trying to delever. The Chinese government is getting squeezed by inflation, and they're raising rates. I mean, if the Chinese central bank was so happy with the quality of loans, why have they just hiked their reserve rate 15 times? They're nervous about something. It's inflation and a growing credit quality problem. So I actually think, and for me as a long-short equity investor, look, China might turn out to be worse than expectations. I think the odds are skewed that way. I look at the valuation, and I know as a stock guy, the odds are definitely in my favor. And so those are some of the slow twitch problems we see. On the flip side, we're trying very hard to find longs. It's hard. My experience through the Asian crisis is that it's all about liabilities. We are going to enter a phase of slower growth of financial credit, and the institutions who survive, they'll have more pricing power, greater market share, but they've got to be deposit and liability-driven franchises. They'll be acquiring other people on the cheap. We know very much who those franchises are. We're accumulating them. We're confident, even if we suffer losses in absolute terms on those stocks, they're going to certainly outperform our shorts. And we do think that on the flip side, the upside in the winning financial institutions will be superb when you come out the other side of the tunnel.
Chris, how about, you mentioned China and the situation in the U.S. How about Japan? What do you see there, given the huge, at least in the market, the stock markets come down? Is there any opportunity in the financial institutions in Japan?
It's amazing because it just seems like they constantly shoot themselves in the foot. They had finally one viable financial. This is very simple. There's a lot of capacity. We never had great capacity reduction in Japan in financial services. So for the banking side, it's been hard. You had these consumer lenders, which were a bit dodgy, to be fair. But the government just blew them up with some regulations because they didn't like people overcharging for interest. Japan has got almost a socialistic element to it. The credit institutions are tough. I will say the Japanese insurance companies are incredibly cheap. They trade below book value. Because everybody drives slowly and they don't sue each other in Japan, it's very nice to run an auto insurance business. As the population ages, they have less accidents. It's a great place to write auto insurance. They've got, of course, big cash balances because it's a short tail business. So as interest rates go up, you actually, which may someday happen in Japan, you actually get a bit more yield. I've been telling that yield story for a couple of years now. The stocks haven't been too bad. But Japan has been tough just on a bottom. You top down, it always looks great. You look at the static valuations like price to book or price to sales, and it looks great. Then you go to see the profits that would create the ROE or the net income, and it's always lacking. So we're finding some stuff there, but it's just been tricky still.
Great. Thanks, Chris. And our last speaker, John Paulson.
Thank you. I wish Captain Bruce was here today to help us, give us some guidance. I would, Captain Bruce, as Steve was telling me, was a navigator and sailed the oceans between Connecticut and China. And I'm sure on many of those voyages he got caught in a deep storm. And I'd consider what we're going through now in the financial crisis, in the financial sector, and the economy we're in the middle of a deep storm. And some of the most venerable and oldest sailors their ships have sunk. And looking out the window, we're seeing big waves, a lot of turbulence. It's very dark and it's very hard to see what the outlook is. At times you see a ray of break in the clouds, and the question is it clear sailing going forward, or is that ray of light going to shut up, and is the storm going to get deeper and worse? And in many respects, we're in the same position as a storm in the economy and in the financial sector. And the question we have to ask ourselves, really the most important question, is the macroeconomic outlook. Are we in a recession? If so, how long is it going to be, and how deep is it going to be? And that overall macro view really guides our own portfolio strategy in terms of our degree of investment, if we're using leverage or converting to cash, and what our long-short exposure is in the portfolio. I would say amongst economists today, there's two basic viewpoints. I think most people have resigned to the fact that we are in a recession. In terms of the outlook, there's a benign outlook that we will have a slowdown in the first half, but we're going to get a pickup in the second half, and overall we're going to have moderate growth in 2008. And then there's a more severe outlook, which believes that we're going to have the worst recession in post-war history, at least since the 73-74 recession. In either case, it's going to be worse than the last two recessions that we had. I personally believe that the latter is the more likely outlook, and that we are going to have a recession that's deeper and worse than the last two recessions we had. There's two major factors that lead me to that conclusion, or are really a compass I'm using to guide my outlook. The first is the contraction in the housing sector. The housing prices nationwide are continuing to decline. And I don't really expect we'll be through this crisis until we get stabilization in housing. The most recent data on housing are very bearish. I estimate, my estimate would be that we're about 50% through the decline. That, using a wide range, house prices will fall another 10 to 20% from the level they are at now. The most recent data show that house prices are declining at an accelerating rate, meaning each month the decline is greater than the previous month. And inventories nationwide are piling up. In addition, we see a severe contraction in mortgage availability. Basically, unless it's a government guaranteed loan, there's very little mortgage financing alternatives available. Until the inventory situation is resolved, until housing prices stabilize, it's unlikely that the economy will improve. Secondly is consumer spending. I think we all know that the biggest contributor to economic growth is consumer spending, and I think it accounts for something like 70% of our GDP. However, credit is contracting for the consumer, which is likely to lead to a decline in spending. Over the last 5 years, consumer spending has grown much faster than personal income, and that difference was made up by borrowing. But now consumer debt service, which is a total consumer debt service measured as a percent of personal income, is the highest level that it's ever been. As credit contracts, and that's almost all forms of credit to consumer, mortgage finance and others, then borrowing falls, consumer has to save more, which means spending has to contract. Adding to the credit contraction is also a rise in unemployment, which is likely to lead to a further decline in consumer spending. The second factor is we're seeing a material fall off, which hasn't happened in a long time, in household net worth. And the consumer is getting hit hard by two sides. The first is housing. As house prices fall, the consumer equity in the home is depleted, and it falls at a faster rate than the decline in housing because approximately 50% of the house is financed by borrowings. Secondly, we're also now seeing a drop-off in the equity market, which is further depleting the household wealth. So taking those two factors in together, the contraction and decline in household wealth, as well as the rise in unemployment, to us it points to a significant contraction in spending, which is likely going to cause the economy to continue declining. So our outlook would be that the state of the economy is not going to suddenly improve. We've just begun the recession, and it's likely going to be more severe and longer than is generally expected. What impact will that have on the financial sector? Well, it seems to be logical to us that if the financial sector follows the economy, and if the economy is weakening, then the crisis in the financial sectors continue to deepen. I don't believe we are at the bottom. There's numerous problems in the financial sector that need to be worked out. And so far, there's been many people since last February that thought we are at the bottom. So far, I'm hesitant to say, but I think it's probably right, almost anyone that has jumped in to go long financial stocks because they thought they were cheap or cheaper than they were a month or a year ago has gotten badly burned. And we know many investors in Bear Stearns, God forbid Joe Lewis, jumped in when he thought that 109 was cheap because it traded at 170, now lost over $1 billion. But there's many investors that made the same mistake in Citibank, including Abu Dhabi Investment Authority, MBIA, or Warburg Pincus, signed a deal at 31. By the time they had a fund, the stock was 12. Thornburg Mortgage, where investors lost money twice in refinancing, and many, many other examples. At this point, it really requires discipline on the part of the investor not to jump in and get sucked into that same trap that so many other investors have gotten caught in. The problems in the financial sector are broad-based. They include regional banks due to many of the problems that my colleagues here mentioned in the commercial construction loan area, other home equity loans, other forms of consumer credit, commercial loans. Credit costs in all these areas are just beginning to rise, and they're rising at an accelerating rate. There's problems with finance companies. GMAC is a big problem waiting to happen. So over $250 billion of debt outstanding. Their cost of funding is something like 950 basis points above LIBOR. CIT is another example. On the bank, Citibank is in a very precarious financial situation. And some of the European banks are more thinly capitalized and more leveraged than the American banks. And regarding the brokers, the problems and the leverage that Bear Stearns had are unfortunately very similar to the leverage that some of these other brokers have. So I don't think we're out of the woods yet regarding the health of our brokerage industry. All these financial companies have several aspects in common. First, they're very levered. As Jody mentioned, the average bank is on the order, or the average financial institution on the order of 20, 22 times levered. The broker's 30 times. Secondly, they are all experiencing rising credit costs. Third, they have declining asset values. And the problem is when you're very levered, 30 to 1, you have declining asset values, it can result in a very rapid depletion of the equity. And that's unfortunately what happened to Bear Stearns. Just a 3% fall in the value of their overall assets wipes out 100% of the equity when you're at 30 to 1 leverage. And many of the assets they have in the mortgage area, in the high yield area, in the leveraged loan area are trading well below 3% of par. Some of these securities are trading at 50, 60 cents, many of them at 80, 90 cents. So our outlook is that we do expect the economy to worsen, and we expect the financial crisis to deepen. And that dictates our portfolio strategy. In this environment, it's not an environment we want to use any leverage at all. We basically built up our cash reserves and minimized our exposure to the equity markets. Our shorts now in the portfolio in total exceed our longs as we prepare, as in a recession, almost all categories of the market decline. Secondly, we're maintaining a short bias on credit, both in the equity and debt securities. And our goal is to produce gains through this market correction, and to continue to build up cash reserves to take advantage of what we think will be, attractive long opportunities once we get through this crisis.
John, you haven't touched on the distressed environment. What's your outlook for investing in distressed securities going out? Are you still keeping your powder dry? Do you think it's a 6-month or a year outlook?
Well, I say so far, anyone that has bought anything in distressed has lost money. So we had that crisis in August when the markets fell. Many people felt that created, terrific buying opportunities. Some managers set up funds to buy leveraged loans of bank debt. At that time, the bank debt fell from par to 95, 97. First data was done in 97. TXU was something higher. And now those same loans are trading at 85, in the 85 range. So there's a danger to jumping in too soon, because distress is basically a long strategy. So if you jump in too soon, you can lose money very quickly. In terms of timing, generally in the corporate credit market, which would be levered loan and high yields, you wouldn't want to buy those securities when you're going into a recession. If anything, you'd want to buy it after we're coming out of a recession, and after the default rate has peaked. Right now, the default rate is at an all-time low. It's less than 1%. The previous peak in the 2001-2002 period was around 12%. So we got a long way to go before the default rate reaches that level again, to creating what I would consider to be attractive opportunities in the corporate area. There's also a distressed opportunity in the mortgage area. But again, the problem, example with Peloton, another hedge fund, they did very well last year shorting mortgage securities. They thought we got to the bottom. They thought there was value, and they switched their portfolio and went levered long, thinking that the mortgage securities had fallen enough. And in 6 weeks, they imploded and lost all the capital. So while I think we're getting, the mortgage securities are becoming more attractive, there's billions and billions of them for sale every day, as many of these firms that implode put the mortgage securities on the market. But I think it's still premature to buy these securities, because until you know how far housing prices fall, until you know what the losses on these pools will be, it's very difficult to estimate what a good value for these securities is. So I think both in the corporate market, and the mortgage market, and in the financial sector, it's still too early to be going long troubled securities.
I'm sure the audience here might have some questions. Brett?
Obviously, all three of you, for good reasons, are still quite bearish. And John talked about things you need to see to get long in terms of the falls peaking, et cetera. Just ask the same question to Jody and Chris. What do you look at, and what do you think you're going to need to see to change your mind to start getting long again?
Oh, yeah, okay. Look, if I think back, the first rule of thumb I have is you're always going to miss the ultimate bottom, right? Anybody, I can remember at the bottom in Singapore, one of the bankers was very concerned for me, and he kept saying, don't buy our stock, it's getting worse. And he was absolutely right. Things were getting worse, but that was the bottom in the stock. So, first of all, you have to accept that things will still be things will still be bad, and that's going to be the bottom. What do we have to see? I think you need to see typically you need to see a slowdown of the growth of NPLs. That's typically an early, that's where you start to wake up and notice that. Number two, I as an equity guy, I do watch quite closely the fixed income spreads because they will typically discount a little bit, again, ahead. And then the third thing is, I have the luxury where at some stage I can buy valuation and assume, look, I won't pick the bottom, but I can get great risk reward. But I don't think we're there yet in the valuations that I see. I think there's the stocks that trade nominally cheap are distressed, and I think we've got to see the good companies trading cheap, and we're not there yet. They've got to overshoot.
I would echo what Chris and John said. What would make me change my viewpoint on financials is when they recapitalize. Either they recapitalize through massively dilutive equity raises, or they recapitalize because the federal government steps in and says, we will buy all these troubled loans at some inflated valuation and get you back in the business of making loans. But until the banks get the non-performing assets off the balance sheets, otherwise get back into business, it's hard to be really constructive on the space. And I agree also in terms of looking for delinquencies not to be accelerating every month, but to be plateauing, and for NPAs to be plateauing. But it goes back to being recapitalized. The banks have to get to the point where they can get back into the business of making loans instead of dealing with troubled assets.
Oh, Dave?
You've all expressed bearishness on financials. A lot of people have expressed their views on corporate credit through CDSs. Yet I presume these exact financials that you're talking about are on the other side of a lot of the credit default swaps. So should we expect that this panacea of credit default swaps as protection is going to turn out to be fool's gold in the sense that it's a good bet, but you can't actually realize it? Talk to me about who is on the other side of all these credit default swaps, and how is that whole game going to play out?
Well, let me take a stab at that. That's a very good question. It is perhaps the biggest financial risk in the system is the credit default swap market. I think Jody alluded to it's on the order of in excess of $50 trillion today, which obviously is an astounding amount. The way, at least our contracts work, is they're what's called pay-as-you-go swaps. So our counterparties are the major banks, Goldman Sachs, Credit Suisse, Deutsche Bank, etc. As securities fall in value or spreads widen, we get margin calls. So they pay us the cash. So if I was short a security, let's say a bond at par, and it's now 10 cents, I've already collected the 90 cents, and that's sitting cash in my account. So if the counterparty was to fail, I'd be, I already collected the gain. I'd probably become a creditor for the last remaining part of the gain. But I've collected in cash all the unrealized gain. Secondly, the counterparty risk is more a risk of those banks than it is for me. Unless you expect Goldman Sachs to fail or J.P. Morgan to fail, they're going to have to honor their obligation to me. And I think the Fed has stepped in and said they're going to do whatever they can not to let a major counterparty fail because of the systematic risk in the system. On the other hand, while J.P. Morgan, as an example, when a security falls, has to pay me cash, they say they're flat on the trade because they bought protection from someone else. But if they bought protection from an SIV, a reinsurance company, from SCA, another monoline, a hedge fund, and those counterparties fail, then that counterparty risk becomes J.P. Morgan's risk. They still have to pay me, although they're no longer collecting from the other side. So they say now they're flat. They bought the same amount of protection they sold. In the event their counterparties don't pay, all of a sudden that becomes their risk.
Sure. And that risk is a real risk because when a hedge fund sells CDS, they post collateral. But if another investment bank or another bank or an insurance company or any highly rated entity single-layer hire writes protection, they don't post collateral because the agencies and the system assumes that highly rated entities don't jump to default. But in a systemic crisis, that can happen, and the person in the middle, once again, it's the broker-deals, have that risk.
I'll say just one other thing. The counterparty risk is very real. Today in the Journal, it's a case with Merrill Lynch. They sold $3 billion. They bought $3 billion in protection from SCA. SCA is close to failing. they can no longer honor their obligation, and they're suing each other, saying we don't have to pay. But if they can't honor their obligation, then all of a sudden, that protection Merrill thought they bought, and they sold to someone else, they now become liable for. So the extent the security falls, they have to pay the other side, but they're no longer collecting from SCA. So it's a very, very material risk for the banks. And the size of the outstanding is so large, if you do get a large amount of counterparties failing, it certainly could severely weaken the financial system.
We've seen, looking at the capital structure, just for a moment, across the capital structure, we've seen a lot of people either raising money or starting to dip their toe in the water on senior secured bank loans. Can you talk a little bit about the continuum of, the more stuff that's out there and the attractiveness, in your opinion, of things like bank loans?
Well, we've looked at most of the leveraged loans out there. The issue is with LIBOR coming down to, I don't know, with the Fed cut the rates 2.5%, let's say LIBOR is 2.25%, 2.5%. So these loans yield LIBOR plus 250. So I get 2.5% plus 2.5%, 5%. Is that an attractive deal for me to invest your money to earn 5% in a levered loan with no covenants, when the total leverage in the firm is the highest it's ever been in the financial sector and the economy is weakening? I don't think it's a very good deal. Now, they have to price the loan down in order to increase the yield. But let's say they price it to 85. At 85, and let's say it's a 5-year duration. So 15 divided by 5, I get an extra 3%. So instead of 5%, I get an 8% yield. Is 8% attractive? Not really. The only way these deals were ever attractive, as Jody pointed to, the buyers used to leverage them anywhere from 4 to 10 times. But that leverage is no longer there. And anyone that bought these loans unleveraged is now losing lots of money. As the par amount of the bonds fall, they either have to sell the bonds to pay off the debt or they have to pony up more equity. So for these deals to get for the leveraged loans to get attractive from our perspective, they have to be yielding from somewhere in the at least low double digits, 11, 12%. And that probably relates to a price more in the 70s than it does in the 80s. And I think as time goes on, as the economy weakens, as some of these firms start to sputter, as more of these previous leveraged loan buyers have to sell the debt, the banks are forced to sell, I think they're going to drift down to those levels. And at some point, if I can get a double-digit return on an unlevered basis, I'll find these loans more attractive.
After listening to you three gentlemen, I guess there's a few things that come to mind which will provoke a question. If you have leveraged entities with stated equity, you can't really figure out what the equity is worth, so even though it's stated as such, it may not bear any relevance to the truth.
Speak up a little bit.
Excuse me?
Will you speak up?
Sure. Second thing is that you mentioned, which is clear, is these entities have so many problems in their system that they don't have time to deal with new activities. So that would then lead me to Sarbanes-Oxley. I'm involved with a number of public companies in Sarbanes-Oxley, and I can tell you that between the extra managerial time, the cost, the diversion of management, that in itself makes it even more difficult to function to go forward. Which will now lead me to my question. If you go back 5 years ago, what could the federal government or agencies that regulate these entities have done that would minimize or eliminated the current problem? And then that would lead to the next question. If they didn't do it then, what could either of them do now?
Well, I'll take a stab at it. If we sort of step back, one thing is it sort of feels like, geez, everybody running these institutions just lost it. And is it possible that there's just a head, that we've just groomed a generation of greedy fools at the head of all these financial institutions. There's something unique about this. So this is on the question of what the federal government could have done. I think the common thread is very simply that interest rates were held too low for too long. It would be as if we held gasoline prices at 25 cents the gallon for several years and were shocked at the end of 3 years when the regulator who was in charge of making sure people only drove to approved destinations and that everybody buys an SUV, everybody drives around like crazy, and at the end of 3 years, we've used up all the gasoline inventory. If you held interest rates so low, everything looks so good, I would go into these banks and say, you're under-reserved by any historical standard, and raise the accounting question. They'd say, show us the loss experience that would justify putting loan loss reserves on the books. And they would put the onus back on us. And I know that's exactly what was happening to the regulators. They'd say, show us the losses. We have no choice but to release reserves and show these great earnings, or we're actually misleading. So I think the thread was the government held interest rates for too low for too long, too much liquidity, and that's the root cause. Simple as that.
You mean the Federal Reserve?
Yeah.
Well, you've got to divide the Federal Reserve and agencies from the government.
Yeah, fair. But I mean the Fed. Okay, so by which I mean the Fed. And as for what you do today, I think you have to do exactly what they're doing, which is provide liquidity and have this deleveraging be as orderly as possible. And it's going to be, remember, the key with financial institutions, I think, is liability driven. Right? The ones with liabilities will survive, good liability base. The ones, Long-Term Credit Bank in Japan, which was later bought by Chris Flowers, I met with them just as they were going under. It was kind of a cruel thing to go in there as an investor. But they said to me, we are a good bank. All we need is time. And, of course, the market didn't give them time. So you need time, right? Those book values, if you have to liquidate them in distress because you don't have liabilities, you get wiped out. So I think the key is the federal government has to make it orderly so that the good institutions can hang on to their assets and participate.
The other thing that needs to happen is accountability for derivatives. It's amazing that we went through 3 conference calls with major broker-dealers over the past 3 days, and no one talked about CDS counterparty exposure. It's just not. And it's the same thing with the GSEs. People talk about the retained portfolio, and they have $800 billion of retained portfolio against $35 billion of equity. But they also have $2 trillion each of guaranteed obligations. That's debt. It's another form of debt. It's not debt. It's not a liability in your balance sheet. But it is a liability of those firms. And those liabilities need to be accounted for. And there needs to be some type of central clearing agency that forces everyone, including broker-dealers and banks, to post collateral so the counterparty risk is reduced. And the minute you start forcing people to post collateral on both sides of the trade, the size of the market will come down to much more manageable portions.
John, you mentioned that you thought that the bottom might be pressed when the real estate market stabilized. Do you see, any of you see really, an RTC type solution in here to at least address that issue, where the government steps in with both feet, put some of these ailing entities out of business, and basically takes over as a buyer of last resort, if you will, of these non-performing loans?
The private sector's done so far a pretty good job of, letting companies fail. We had quite a few mortgage companies fail already without government intervention. We had New Sanctuary, which was the second largest subprime lender in the country. They failed, and the assets were redistributed. American Home Mortgage, they failed, last July. You had AmeriQuest, which was the largest subprime lender. They failed. Option One failed. Many mortgage companies have failed, and there were purchase of the securities that were redistributed. The government, so we haven't yet had the need, so far at least, for something like an RTC, a Resolution Trust Corp. But the government is certainly being very proactive in trying to inject liquidity. They certainly empowered the Federal Home Loan Administration to increase their loans to lower quality borrowers. And yesterday they relaxed the capital requirements of Fannie Mae and Freddie Mae. Encourage them to raise more capital to, encourage them to lend more money. And as a matter of fact, the government has done so much. The estimates today that between the Federal Home Loan Bank and Fannie and Freddie and Ginnie Mae, that the government may, back somewhere between 80 and 90% of all new mortgages made in 2008. So they are doing as much as they can to help the system. However, even Freddie and Fannie, they are legitimate lenders. They require a down payment, generally of 20%, and they require full income verification, and they require the borrower to have enough income to service the loan. And unfortunately, that about 40% of the mortgages made in the heyday didn't meet any of those criteria. So while they will help to provide financing to legitimate buyers, there's a huge segment of buyers that really shouldn't have been having mortgages they're going to run into trouble, and these government programs won't be able to help them, and that's likely going to lead to further foreclosures and downturns.
Any other questions?
Chris mentioned something earlier about securitization of mortgage market and how the domino effect sort of, I think you call it the twitching, how it's spreading from one market segment to the other. There is this debate out there from more of a macro standpoint, if you think about it that way, that the U.S. problems are only U.S. problems and that Europe is sort of all isolated from this. And hence, you could take that one step further, we should be selling the dollar. As a result, commodities led by the precious metals or energy or base metals or ags, they're all safe havens, hence they've been rallying substantially. But I think there are chinks in that armor now. If you look at it, the European banking sector is also seeing some problems. SocGen was one example, maybe a rogue trader, you can put it up that way. UBS is at the multi-year low. CSFB just this morning talked about their own problems, that their traders have been marking down the prices only recently when they should have done it a while back. And HBOS in the UK acknowledged a problem. So maybe it's not just a U.S. problem, and because of the securitization and because of housing price declines that are happening in the U.S., maybe do have global implications in that Aussie, Kiwi, UK, especially Spain, where there has been leverage and inventories are high, like the U.S., could have implications for those markets from an economic standpoint and from the financial standpoint where they may also have bought U.S. securities because of securitization, and hence their banking sector could be also at trouble. So if you go by a coupling theory where U.S. problems will in fact spread to those markets, what is your view? Where do you come out on this coupling thing? Because if you do believe that dollar should be rallying from here on and the commodity should be declining, and from an economic standpoint, the problems won't be just U.S. They could be more of a global in nature.
Well, I mean, I guess I planted that with you beforehand, so well done. Look, I have to tell you, most of my career has been focused on the U.S. and Asia, and I have started in the last year to do a lot more work on the European banks. And in the U.S., if I were to just compare the banking systems, in the U.S., if I take the aggregate loan-to-deposit ratio of just domestic deposits, I think it's about a little over 100%. If you take offshore deposits, we're a little hotter. We're probably around 100. So for every dollar of deposits, we put out a dollar of loans. Now, it's harder to get aggregate data for Europe, but on a bottoms-up basis, I have just been speechless when I go through these European financials. I'll give you one example. There's a bank in Belgium called Dexia. I backed into it through looking at FSA, which is one of the monolines that is supposedly good, the good monoline. And and one of the reasons it's the good monoline is because they have this parent in Belgium. So let's go look at what's going on in Belgium. So first of all, the balance sheet of Dexia, bear in mind it's a Belgian bank, population 10.5 million, is 604 billion euros. Or what, about $1 trillion or about $100,000 per Belgian. Anyway, I mean, so the tangible equity supporting this is 14 billion euros. It declined because of marks on securities. It's 2.35% of tangible assets. So they're levered nearly 50 times. the deposits, and I talked a lot about liquidity and liabilities being that in a tough time, that's what lets a bank survive. I mean, believe me, in the Asian crisis, HSBC had some real bad loans, but no one was asking for their money back from HSBC. So they could hang on and work it through. Dexia, $125 billion of deposits. So call it $15 billion of equity, $125 billion of deposits, $460 billion of others. And, I mean, you know, and they've got a lot of risky assets on the balance sheet. So the Europeans, even if they don't have, let's say they don't have, I called someone at the rating agency the other day, he's like, we do not have such a, I'm half French, so I get to do this. We do not have such a low documentation loan as in the United States. And I said, but you're so levered, even any conventional storm is going to blow you over. And you know, they really feel that it's different. And so the thing about Europe is, let's even grant them that they won't have the asset problem. The capital levels are appallingly low, and it's not so much securitization, but it's reliance on wholesale funding. It's just the Spanish banks, the UK bank. This is why Northern Rock went. It's just that their funding is far more vulnerable than ours. So I think that, number one, I think the odds are against decoupling, and I particularly point to China as an egregious example. I mean, we've had a little credit quality problem in China, but secondly, Europe is in trouble, and I think that I've already discussed the Chinese banks where there's some question marks. So yeah.
Do we have time for another question? Yeah. Yeah.
I know HPD is accelerating recently, but I saw some numbers yesterday that showed 0 for remits, 0 to 30 between December, January, and February is declining, and 30 to 60 was declining between January and February. Is that anything to remark on?
What is HPD?
Price appreciation.
Can you repeat your question? I didn't follow the question.
Okay, I understand that home prices are falling, but I saw some remittance reports yesterday that showed between December, January, and February, the 0 to 30 delinquency bucket fell. Is that anything to remark on?
I haven't seen the report that you're focusing on. The 0 to 60 delinquency data and the 0 to 90 delinquency data has been skyrocketing. The losses have been expanding beyond subprime to Alt-A to home equity lines. If you look at the delinquency rates on home equity lines, where Alt-A delinquencies are averaging about 12% right now. These are supposed to be like prime loans. Prime loans are averaging about 3.5%. Conforming primes averaging about 100 basis points. And every month we see data, the data shows an acceleration of those 60 and 90 delinquency levels. So what's happening now is some of the banks are trying to be more preemptive and they're trying to like take down delinquencies by forgiving, by like this amazing thing Fannie Mae created. You guys, this 2 weeks ago, Fannie Mae's trying to figure out how do we stop all these delinquencies in our prime mortgage portfolio. So what they decided to do is they'll give any borrower who's having trouble an unsecured line of credit with a 15-year maturity. And whenever they can't pay their interest payment on their Fannie Mae guaranteed mortgage, they'll just advance them the money from that unsecured 15-year line of credit. Keeps the loans performing, but doesn't address the fact that the borrower is in a house he can't afford to be in. Just delays the day of reckoning and allows Fannie to not have to buy the mortgage out of the pool, because they used to have to buy defaulted mortgages out of pools. They changed that too, by the way, in December of this year. It used to be that when a mortgage defaults, Fannie and Freddie, after 120 days, bought the loan out of the pool, paid off the pool apart, and then restructured the loan. And that was part of how they had less loss severity than commercial banks did. But they can't afford to buy the mortgages out anymore. So they changed the rules in December. So as of January, they no longer buy out defaulted mortgages. Instead, they leave them in the pool and they advance principal and interest to the pool to keep the pool constant. And they let the servicers deal with servicing the loan because they want to focus on originating new loans. They try and grow their way out of the problems. But again, they're levered 150 times. They used to earn guarantee fees of 15 to 20 basis points a year. Now they're trying to raise it to 30 basis points a year. That's before costs. You can't earn your way out of those types of problems.
By the way, sometimes there's some seasonality in the consumer delinquencies. They tick up month over month towards year end and then actually decelerate a bit in the early part of the year. But that's in addition to, I think, the restructurings, there's a bit of seasonality on the month over month data.
As it seems like you guys have more of a short disposition or more of a short posture here, how do you deal with bear market rallies?
Well, we have
Can you repeat the question? We couldn't hear it.
How do they deal with bear market rallies?
Well, for us, we've pared down our total exposure. So, number one, so that way bear market rallies, since we're not fully invested, won't have as big an impact as they would if we were fully invested or even levered. Secondly, while we're short financials, our longs is basically equal to our shorts. However, our longs are in other parts of the economy that are doing well, or other events that are in parts of the economy that are related to the financial crisis. So when we get a rally like on Tuesday, we're clearly losing on the short side, we're making on the long side, and overall, the short-term volatility is reduced, and we're able to continue to profit as the long-term or intermediate trend is down.
The other thing you can do is, against your shorts, you can sell puts, and then you use some of the money raised by selling puts against your shorts to buy calls, and that kind of helps limit the tail risk. But days like Tuesday are painful days.
Yeah, I mean, I'd echo the same thing. Dial down your gross a little bit. We work very hard to find longs that we're comfortable with through the cycle so that we have less basis risk in the portfolio, and also keeping a jar of Pepto-Bismol in the office.
Thank the pain.
All right. Well, without those comments, we can go off to the real world here, and hopefully we'll stop picking up the pieces, and maybe next time this year we'll be able to have some more positive commentary. Thank you.
Thank you, Liz. Can you close that door, please? Thank you. Just 1 minute. Couple of housekeeping items. On April 17th, we'll meet back in the room on a session that Ryan Dartnell will be moderating on Eastern Europe. There will be a Board of Trustees meeting in this room immediately after this session right now. And I want to just make an announcement about the seating again. If you'll look at your name tag, behind your name tag, if there's a little star or something on that, you're a member of record and you should be sitting in the inner ring. If you're not, if you don't, and you are, you shouldn't be. And that's the way we're running things now. So just make a note of that. Tell your guests and tell your colleagues that the members of record sit in the inner ring. It's sort of word of mouth we're doing this by. I also want to thank everyone who participated in the Quinnipiac University study. It was fantastic. Everyone who answered it, everyone who designed the survey, and secondly, to the Research Council who funded it. It was very, very good, and look for more of these to come out. But it's a collaborative effort, and it just goes to show that we're educating the community, and we're somewhat of an intellectual cooperative. And with that, I would like to welcome the newest member of our family, our underwriter family, Marina Lewin, and one of the last banks standing of high quality, and she might have a few words for us today. Marina?
I realize that I'm what stands between you, the door, and the start of your workday, so I'll be very, very brief. I want to thank, on behalf of the Bank of New York Mellon, we want to thank Steve and all the panelists for a terrific conversation this morning. We, at the bank, as alluded earlier, the Fed is pumping tremendous liquidity into the marketplace. As a leading securities processing provider, we're very pleased through our broker-dealer services to be supporting the effort of the Fed to be pumping, I believe it's $200 billion of liquidity into the market through some of the services that we offer as a securities processor. We are very excited to be here today to be participating in the conversation this morning, and we look forward to continuing our partnership and our conversations here and through some of the activities that we also do through some of the research we do at the Bank of New York Mellon. And again, I thank everybody and look forward to working with you in the future.
Thank you, Marina. Thank you, Liz. And gentlemen, well done. Thank you for telling us the truth today.